This is the current federal tax developments for the week of January the 21st, 2019. Current federal tax developments are brought to you this week by Kaplan Professional Education and by your state Society of CPAs. Well, it was certainly a busy week, and a busy week very much at the end. For those who are not aware, somewhere around 2 p.m. Eastern on Friday, the IRS released the final regulations under 199 Cap A. We had learned earlier in the week on Thursday, actually just the day before, that they had cleared OIRA. Late Friday, they came out. So we've been looking at that. I've been looking at them this weekend. That's why I'm taping this week on a Monday rather than on a Saturday or Sunday. I've been spending some time looking at the regs. We'll do a brief overview of the changes, and we'll talk a little bit more about other issues that are coming up. But the big change is we have a new safe harbor for rentals, which was also kind of something brand new. In addition, and by the way, it's a safe harbor for whether the rental is a trade or business. We also had a few other things happen during the week before we knew we were going to get all this stuff 199 Cap A. We did have a trust case based on going to the Supreme Court that looks at when a state can impose its income tax on a trust or estate. We have the IRS officially reversed position on whether refunds for the minimum tax credit that have been caused by the Tax Cuts and Jobs Act provision repealing the corporate minimum tax would be subject to the sequestration, get the right term, reduction. The IRS said originally yes. OMB said no, we don't think that's the case. Now the IRS says, okay, we'll go with OMB. It's not the case. We have as we said, a proposed safe harbor for rental as trade or business under 199 Cap A. We'll talk about that issue. We have final regs out actually in another area too, the 965 transition tax that we computed last April. We now have final regs on that. That's kind of nice. And the IRS granted limited relief for underpayment of estimated taxes that arise from Tax Cuts and Jobs Act. So as we say, lots been happening, lots been going on. Well, we are entering into, as we said, tax season approaches, and we are coming up on this. Now, one thing I want to tell you about as we get to what's happening, because of all the stuff on 199 Cap A that's come out, we actually are going to be doing a couple of courses in that area. We'll talk a bit more about this later, but the big catch is coming up this Friday, I will be doing a webcast for the Idaho Society of CPAs, which will be 4 hours all on the new tax law, all on the, not new tax law, I should say, all on the new 199 final regulations, going into that now in detail as to how 199 Cap A works. And with that, we've got right now, it's about a 180-page book that has the details, does an analysis of 199 Cap A. And again, that's all coming up this Friday. It's a webcast, so if you want to sign up for that, go ahead and check the Idaho Society of CPAs website. I'll also be doing a live session in Phoenix on February the 11th. And that session will be 8 hours going over all these wonderful details. So that one could be a little more interesting, you know, a little longer, shall we say. And it's a little more time I've got to look at stuff by then. But yeah, so if you're looking at getting something real quick, we do have ways of getting that done this week. Just thought I'd let you know. So let's go ahead and see, though, what do we know about these new regs? For those who are not aware, the final regs have come out, but we don't have a Treasury decision number yet. So it's still listed as 4X's in the actual copy that the IRS has made available on their website, but it was released on Friday the 18th. As I mentioned, and we'll go into more detail later in this program, we have a new safe harbor for rental real estate to treat it as a trade or business. We'll talk about how that rule works. Some changes, and this is just highlights of some of the changes, and these are things actually I ended up doing a very quick extemporaneous session at the Phoenix Tax Workshop on Saturday about what changed in this because we had to fill in for a missing speaker. And this is basically the list that came up before that for that session. If you were looking, remember under the old proposed regs, there was an incidental business rule where if you had a business that shared some resources with a specified service trade or business and the revenue from that business was less than 5% of the combined revenue, that other business was considered part of the specified service trade or business. Had the example of the dermatologist. That's gone from the final regulations. Also in the final regulations, the capital gains limit for taxable income for 199 Cap A, remember, is 20% of your qualified business income and your REIT PTP dividends. But then, or if it is less, 20% of taxable income reduced by your net capital gain. The final regulations clarify that net capital gain includes anything taxed as a capital gain. That includes things like 1231 gains come out of there. Also includes qualified dividends will come out of your taxable income. So they made that very clear in the final regs. That wasn't totally clear in the proposed regs, but now they've clarified. So yes, the dividends come out. A change in the final regs, they allow us now to do aggregation at the partnership and S corporation level. In the proposed regulations, only the taxpayer could do that. Taxpayers could do it, trusts and estates could do it, but partnerships and S corporations could not. In the final regulations, partnerships and S corporations can aggregate if they meet the requirements for multiple trades or businesses. Okay, we have all of those neat things happening. Okay, we also have a simplified partnership allocation of the unadjusted basis immediately after acquisition of qualified property. You know, that second test for the limit. The original proposed regulation had a very complex allocation method that required you to find out the fair market value at the end of the year for every asset for which there was no depreciation claim during the year, but was part of UBIA. And then you had to go back through 704B and 704C and figure out where the gain would go if we actually sold it for that price, and it actually had to allocate that gain, and then we'd allocate our UBIA based on that. The IRS got rid of that. We're now just going to say if there had been depreciation on this asset, how would it have been divided up among the parties? And in that case, that will allow us to derive the UBIA in a somewhat easier way. I mean, the prior method was not very practical, and I think the IRS figured that out when they looked at the reg. Some other key changes. The IRS went back and clarified. Remember, there is a special rule that if you rent to a controlled business, your rental is a trade or business. Now the IRS clarified in the final reg that that rental has to be to a pass-through entity. So if you rent to a controlled C corporation, that will not make that rental automatically a trade or business. Okay, that's a change from this. The IRS made it very clear in the final regulations that if you go over the de minimis test, remember de minimis said if less than 10% of your revenues came from a specified service trade or business type activity in a trade or business, and it was revenues of less than $25 million, that you basically could treat that as ignored and don't worry about the fact it's SSTB. And if it's above 25 million, then we get to 5%. The IRS made it very clear in the final regs that if you go, once you go 1 penny into the bad area, you actually get to 10%, you actually get to 5%, then the entire business becomes a specified service trade or business. It's not divided into two parts. They rejected that entirely, so you don't have that option. They made a significant change, well, at least significant if you're a radiologist or a pathologist, a significant change in the definition of health care for specified service trade or business. They removed the reference there about seeing patients in the definition of what's a healthcare option. So now what's going to happen is, let's say like a radiologist who merely reads x-rays but never actually interacts with patients, just gets them to read. That radiologist didn't have a specified service trade or business. Pathologists, same way. They were just, reading tests. They were not actually going and interacting with patients. Those people under the proposed regs, it appeared they were not part of a healthcare profession. Under the final regs, yeah, they're now part of a healthcare profession. So now the thing to remember is for 2018, and the regs make this very clear, you have the option of using either the 18 proposed regs or the 19 final regs. The final regs have to be used for 19 and future returns, but for 18 returns, it appears you can use proposed regs, and then you can, read the regs, check the rules, be careful how you read this, and, remember, even if you consider not seeing patients, revenue from not seeing patients as not being SSTB income, if more than 10% of their income comes from seeing patients, then they'll still be an SSTB. But if they meet the requirement, a pathologist or radiologist may be not an SSTB for 18, they probably will be one for 19. So we have to take a look and be careful there. And again, make sure you do the research. Don't just go off and say that, somebody told you that radiologists were okay for 18. Nope. You have to go back and check the way the definition was found, the way the definition worked in the proposed regulations. Check that versus the final. But the reference to patients was pulled in the final regulations. The final regulations also hold, this was something that was not really answered in the proposed regs, and that is Do we have to subtract self-employed health insurance deduction, the SC tax deduction, and the KEO or SEP contribution for the owner in computing qualified business income? The IRS ruled in the regulations now make it very clear that those three items do reduce qualified business income. So you have to pull them out if you're doing QBI. Again, these regulations came out on Friday. People are just now adapting to them. Be very, very, very careful with your tax software, because obviously your tax software, if it's trying to compute these numbers, didn't have these regulations. And remember, you do have a choice between the 18 or 19 regs. So you want to make sure that you take a look and see which works out best for your client. Let's go on and talk about some of the other things that happened this week. There were other things that happened. Okay. And one of the other things that happened this week is the state of New York finally told us how they feel about the Wayfair case. New York Notice N19-1 issued on January the 15th. And New York's made decisions about how to handle these out-of-state sellers. And what they're saying is, if you have sales into New York of more than $200,000 and more than 100 transactions, that's interesting because that's an and, not an or. Remember, in the South Dakota case, the one the Supreme Court said was okay, they test you for or. Do you have so much in revenue and sales or so many transactions in the state of South Dakota? In New York, you have to have both 200,000 of revenue and 100 transactions. So if you sell, in this case, remember, for 100 transactions to go over $200,000 in revenue, we really need each transaction to be 2,000, right? Basically. So we need that much to make it go. So bottom line, if your average revenue from a sale is like $100, you could have 100 transactions and not worry about having to collect New York State sales tax. Well, that's the good news. However, not all news is good. New York decided, since that law has been on the books for decades that said you had to collect that stuff, actually, you should be complying right now. And I mean, they mean literally right now. You should be complying. So New York's going to start looking for immediate compliance. They're not giving, most states gave people some time to adapt. They put out an announcement. They said, we'll start collecting, for instance, if we had the time frames many states had used, they'd say today, yeah, this is what we're going to do. And we're going to give you until, let's say, April 1st to register and start collecting the tax. Now, New York's theory is, we've told you years ago you should have done this. Turns out Supreme Court says we were right. So yeah, start collecting now. Next up, well, the Supreme Court had so much fun upending the world in the area of sales tax. They're now going to take a look at income taxation of trusts. The U.S. Supreme Court granted cert in the case of North Carolina Department of Revenue versus Kaestner Family Trust, case number 18457. Certiorari was granted on January the 11th of 2019. This particular case we discussed before. The Supreme Court of North Carolina said that North Carolina's law was unconstitutional, basically, because it imposed a tax on an heir, but not on heir, imposed a tax on a trust solely because it had a beneficiary who received no distributions during the year, but who was a North Carolina resident. It did not have any North Carolina property. The trustee was not North Carolina, had no other real connection with North Carolina except a beneficiary lived in the state of North Carolina. The North Carolina Supreme Court ruled that's not enough connections to meet the due process requirement of the U.S. Constitution. Therefore, they said the state could not impose its tax. The North Carolina Department of Revenue has appealed that case. The U.S. Supreme Court has decided to pick up that appeal. Now, it's tough to say. The Supreme Court's picking up this appeal pretty clearly because there is a split in the circuits. Different courts, and not so much the circuits, but to be totally honest, a split in the state Supreme Courts. Certain state Supreme Courts have held that having a beneficiary is good enough to allow the state to tax the trust for undistributed income. Other states have ruled it's not enough. We've also had states rule on other issues of how we tax trusts for state purposes. There are a wild set of rules that are used for taxing a trust. In fact, I've been in looked at various states, done various ones. I have said tongue-in-cheek, I remember looking at North Dakota's a couple of years ago and decided that if you really read North Dakota's rules, as far as we can tell, every trust in America should file a North Dakota income tax return and pay tax to the state of North Dakota on all their income because of how broad their definition is. Well, the Supreme Court's going to come down and take a look at this. Now, we don't know how the Supreme Court's going to handle this. what they're going to do with it. Are they simply going to rule solely on the facts in front of them, or are they going to produce some sort of broad set of rules about when the states can tax trusts? And maybe we go beyond that. Maybe we go to income taxation in general. This is important and of interest because this will be the first time we've had a major case in another type of tax after the Wayfair decision came down from the court. This will be interesting to watch for. A similar case in Minnesota is Minnesota Department of Revenue has also asked the Supreme Court to hear a case where the Minnesota Supreme Court found that the state of Minnesota could not impose a tax on a trust, where the only connection with Minnesota was that the original grantor had been a resident of Minnesota when the trust was formed, but now many years later, they have no connection with Minnesota at all. Minnesota Supreme Court ruled same way, not enough connections for due process. If the Supreme Court picks that case up, then we're probably looking at a much broader ruling. If the Supreme Court only decides to go with this case, then it's not clear how far they're going to go. But in any event, it could be a very interesting case because the certiorari has been granted. So we're going to watch this case, see what comes down. Just be aware, if you have a trust that has a North Carolina beneficiary, you better consider filing, this year you're going to file kind of a protective return, to get yourself in there, but then also want to ask for your money back, right? Saying that, okay, we understand that you guys say, the Supreme Court of North Carolina says we don't have to file. You guys, however, say you think we do, and you're going to Supreme Court to get this overturned. So we're kind of in a bad position. Yeah, be careful dealing with North Carolina in that case. That'll make it interesting. If they also decide to grant cert in the Minnesota case, that could also be very interesting as to how you handle a Minnesota trust if your grantor lived in Minnesota, but now at this point, the trustee's not there, the heirs aren't there, the property's not there. Again, very interesting how that gets handled. And it's not just those states. I mean, as I say, most states have states have a whole wild variety of theories under which they believe they can tax a trust for income tax purposes. The question is going to become, does any of that work? Do they have the broad authority, which would be the theory, which could be how the Supreme Court could rule following Wayfair, that almost any connection is enough, or are there more limited rules in a trust scenario? So keep your eye on this case. The IRS had an about face on a rule. They posted finally on their website. It's called The Effect of Sequestration on the Alternative Minimum Tax Credit for Corporations Fiscal Year 2019 was posted on their website on January 17th. And what this has to deal with is the IRS initially ruled, remember, under the Tax Cuts and Jobs Act, corporate minimum tax was repealed. If you had a minimum tax credit carried forward into this year, you'd use that to offset your regular tax, and then you get a refund equal to half of the remaining balance, right? That would end up going for a couple of years. Now, the IRS ruled initially that this would be covered by, remember we had a Budget Act a couple of years ago that had a special rule on sequestration, where they said if they didn't cut the budget enough, that certain things had to be reduced. And one of them was certain refundable credits, of which this was one. So there'd be a 6.2% of the refund would be withheld. The IRS had ruled initially that that would apply to the Tax Cuts and Jobs Act refunds. The Office of Management and Budget ruled that won't happen. So now the IRS says, oh, okay, yep, we're on with that. It will be that way. However, if you are, so they're going to file OMB. However, if you are filing a fiscal year return before that, and you're asking for the refund based on the special rule that if you gave up your bonus depreciation, you could get a minimum tax credit refund, that will still be hit with sequestration. And again, and the way it works is kind of weird, but it's for any return processed during the fiscal year. So again, kind of interesting in how this works, but the sequestration, so the plain refund, that could impact, again, you might not want to give up for 2019, let that roll in left for 28 for the fiscal year beginning in 17. You might want to let that roll to 18 and then be able to get the non-reduced numbers. Again, it'll take you a few years. Ultimately, you get all the money back. But you might want that instead of getting hit with the sequestration limit if you try to go for go for a refund on the earlier year. Okay, what was probably the biggest thing that we need to worry about this week? We're going into some detail. Again, the 199 Cap A regs, I'll probably do a little bit more on that next week when I have time to really look at it in detail. I just barely got through scrambling through all the pages, updating the manuals, getting things ready for the session on Friday. So I'm getting in that position pretty good, but then we may talk a little bit more about how this works next week on other issues there. But this is probably the big thing. Notice 2019-07 that came out with the final regs. That notice has in it a proposed revenue procedure. The proposed revenue procedure in this allows us a safe harbor test for whether our rentals are a trade or business, okay? And this is it. Now, it's solely for this purpose, right, that we use this. You test these things called real estate enterprises. And it's an interest in and property held for production of rents and may consist of multiple properties, okay? The one thing you cannot do, though, is combine commercial and residential properties in an enterprise. So we have this new grouping classification that's called enterprises in order to determine if we have a trade or business for rentals for purposes of 199 Cap A, at least under the safe harbor rule. So we put these things together, okay? Now, then you test your enterprise, okay, to see if they meet the requirements. To meet the requirements, an enterprise has to meet the following requirements. Separate books and records have to be maintained to reflect the income and expenses for each rental real estate enterprise. Okay, that's probably not that big a problem because, it would seem that given the way this is worded, we should be able to take the separate books we've kept on 4 rentals and combine them. That shouldn't be a problem. If you just put everything to one giant pile that was rental, right, and separate things out, we got issues, but that's okay. And for taxable in years beginning before January 1st, 2023, you have to have 250 more hours of rental services performed per year with respect to rental enterprise. Now, those services can be performed either by the taxpayer or by the taxpayer's agent or representative. So interesting enough, if you have a landscape crew come in and do landscaping work, those hours count toward the 250. You have a plumber come in and do some repairs on the property. Those hours count toward the 250. Okay. So any hours spent in qualifying activities. Now we'll talk about what qualifying activities here in just a second, but anything in qualifying activities counts to 250. Once we get to December 2023 and later, then it'll be in any 3 of 5 consecutive years that end with a taxable year. If you have 250 more hours with respect to those real estate enterprises, could be considered a trade or business. So we're going to be allowed to kind of miss every so often, miss 2 of 5 years of the 250, and some will stay real estate enterprises. But for the short term, we've got to have 250. And then here's the catch. This one is waived for this year. The taxpayer needs contemporaneous records, including time reports, logs, or similar documents with regard to the hours of services performed, description of all services performed, the dates on which the services were performed, and who performed the services. You have to be able to make those available on exam. Now, again, that is waived for 18 because most people won't have that for 18. But for 19, you've got to start having that. So you need to reach out to your clients who might meet these requirements and tell them right now they've got to start getting this information on the rental properties because they're going to need it. For the 2019 returns. Won't need it for 18 returns. We'll have to have some way of demonstrating our hours, I guess, on the exam, but we don't need these detailed records. But these are very specific and detailed records you need in 2019, so you better start informing your clients about those needs. Now, rental services that count for 50 hours test, those include advertising to rent or lease the land, real estate, negotiating and exercising leases, verifying information contained in prospective tenant applications, collecting the rent, daily operation, maintenance, and repair of the property, management of the real estate, purchase of materials, and supervision of employees and independent contractors. Again, taxpayer does not have to be performed. They can be performed by owners or by employees, agents, or independent contractors. The total, all of those, just total those up, get them to 250. By the way, this then creates an issue. Your landscaper has got to give you documentation of their hours. You can say when they were there and how many hours they were there. And of course, they're probably not billing you by the hour. So they're going to think you're crazy when you start telling them, well, I need to know how many hours you were, but when did you start? When did you end? It's like, well, I need to know that because, we need to know that because I need that for my rentals. So that's going to be kind of interesting. Okay. We have to make those inquiries. Now, the term rental services does not include, you can't count these, financial or investment management activities, such as arranging financing, procuring property, studying and reviewing financial statements or reports on operations, planning, managing, or constructing long-term capital improvements, or hours spent trading to and from the, or traveling to and from the real estate. So none of those count for your 250. So again, you got these qualifying activities, non-qualifying activities, right? Also, some rentals cannot use this, okay? And excluded includes, any of those. If the real estate is used by the taxpayer as a resident for any part of the year under Section 280 Cap A, you cannot use the safe harbor. So that means obviously your vacation rental's not going to work, all of that thing. If 280 Cap A, any part of the residence is covered by that, of the property is covered by 280 Cap A, used as a residence, then we've got a problem. And also, triple net leases cannot qualify under the safe harbor. So your triple net lease cannot meet that requirement. Realize this is merely a safe harbor. If your client does not meet this test, you go to the standard test. Now, we've discussed before, if you've taken any of the courses, at least in the courses I've given on this topic, that the standard test is a bit uncertain and especially bad in New York and Connecticut, as we've said in the Second Circuit. But you still can go to that. So you can either use the safe harbor or the standard test. Remember, the safe harbor is an opt-in deal. So, take a look at that. But for those who wanted some certainty about this, we now do have some sort of definition for how rentals can be handled. Hey, well, the other final regulations were released this week. Again, we don't have a number for Treasury decision, but it was issued on January the 15th. And this was our first set that came out of OIRA since the government shutdown. And we were a little concerned about how fast to make it out of there. That was good. We got them both this week. And obviously, as we said, wouldn't be the last one of the week. We got extras. It's mainly the same 965 transition tax. They made very few changes from the proposed regulations. Almost nothing significant. There were some changes liberalizing determination of cash position, but basically these are very similar to what you had this summer. You probably want to review them because we're now coming up on the time. Remember that the IRS gave us kind of a pass as long as we got everything fixed by this year. You might want to go back now and review. Those regs are final. So if you had any questions, you've got as much answers. You got as much way in answers as you'll probably get. We now have them though in the final regs. You may want to review those. Also this week, the IRS announced in Notice 2019-11, announced on January 16th, that they would be waiving certain underpayment of estimated tax or penalties. There had been concern expressed by a number of parties that because of the way withholding changed this year and because of the changes in the tax law, some taxpayers who previously had not had a problem with withholding being adequate, so they didn't get hit with underpayment penalties, this year may discover they're underpaid because they didn't have enough withheld and they're not used to the new tax system, so they weren't aware, of how they wanted to adjust things. So, there was a lot of pressure on the service to come up with some sort of waiver system. And so the IRS came up with one, but it is limited. Be aware of it. What it says is, as long as you paid in at least 85% of the tax due in withholding, 85% of the real tax due in 18 via withholding, you can qualify for the exception. You will have to follow the Form 2210. You will have to mark the box on the front that you're going to qualify for the waiver. You'll have to explain why you're doing it. It's going to come out of this notice, but that's fine. You qualify. The big catch, though, a couple of catches. First thing is it's only 5% less than normal. So, you're underpaid, but not by a huge amount. And then secondly, if it turns out you're 84.9%, well, you're out of luck. The penalty will still use the 90% payment amounts to compute the 2210 penalty. So they won't reduce the penalty to being 85% should have been the required payment. They're going to make the required payment still 90% for computing the penalty, but for getting out of the penalty, if you pay in 85%, they'll give you a penalty waiver. Again, interesting issue, be aware of that. It does mean that, make sure you carefully check your software, especially if you're doing earlier tax returns. There are people that want to file right on the 28th. Check carefully. The good news is those who want to file 28th probably want to file because they're getting a refund. If they're not getting a refund, they probably won't be as quick to move. But if you are filing any here early in tax season before the tax software gets this incorporated, you want to make sure you check those and consider consider holding them until the software gets it right, because you probably can't enter things the way the IRS is going to want it until the software gets it right. Or I suppose you could even paper file. Who knows what happens with those these days, but you could try that route. Well, it is the last chance for state society courses. And by the way, 199 Cap A with the changes, it's really important to get up to speed on what the 199 Cap A changes are. We're going to see courses coming out now, and they're going to come out rapidly because we all know we're getting toward the end of January. We're heading toward tax season. We're running out of time to be able to go through these courses, but it's really important you understand what happened with Cap A, because you have your choice between the 18 or 19 proposed regulations. I will be doing a 4-hour session for the Idaho Society of CPAs this Friday, January 25th. It will begin at 9 a.m. Mountain Standard Time, right? You can sign up for it at the Idaho Society of CPAs website, www.idcpa.org. It will be 4 hours of CPE credit. You can sign up there, see what it goes. We'll go over that. As I said, the PDF manual, we'll have both the PDF manual and we'll have the standard slides. The PDF manual is going to be over 180 pages. So, and it's really a reference manual that goes through most of this stuff. And then we'll talk to you during the course about what's changed. It will be a 4-hour course. You can sign up right now. Probably should do so because we're running out of time for the week. I'll also be doing a session for those of you here in Arizona. I will be doing an 8-hour session in February, on February 11th. An 8-hour session that will go over the same topic. There, we're going to expand up a bit, obviously. So, whichever way you want to do it. I know a lot of you really want to get, a lot of you don't want to be doing things February 11th. So you might want to consider the January 25th course, and we'll go over what we've got there. But obviously, I think it's really important you do something to get up to speed on what happened with 199 Cap A prior to going through and doing your tax returns for this year, and especially get up to speed on that rental safe harbor. This has been the current federal tax developments for the week of January the 21st, almost said 25th, January 21st, 2019. You can follow our updates on the website at currentfederaltaxdevelopments.com. By the way, on that website, we have a link to the 199 Cap A final regulations. If you have not gotten that, time to go get that too. Hate to say, but you probably got to read them. You have any questions or comments, you can send them to me, Ed Zollers at currentfederaltaxdevelopments.com. You can follow me on Twitter. There I'm at Ed Zollers is the link there. I also follow discussions on a number of discussion groups. I follow the Reddit group Tax Pros, so /r/Tax Pros on Reddit will get you there. I follow the Connect groups at the Arizona Society of CPAs, the Minnesota Society, and the New Jersey Society of CPAs. We'll try to, follow some discussions there. Also check in from time to time on Tax Talk for Cal CPA. Again, been a fun week. Got lots going on, lots happening. And yes, I realize we're getting that part of the year where, hey, it's almost time for tax season to go. And you know what? We're still getting rules. And the bad news is we're going to keep getting these rules all the way through the process. So be sure you check in with us next week as we talk about whatever else might come out in the area of current federal taxes.